Hello, everyone, and thank you very much for joining the Greater Kingston Chamber of Commerce Member Exchange. Today, I am going to be speaking about the 2026 Kingston Retiree Tax Traps, 5 legal strategies most advisors will miss. My name is Sean May. I'm a certified financial planner. I'm also a chartered investment manager and fellow of the Canadian Securities Institute, and I've been here in Kingston helping families and businesses since 2004. I live right here in the West End of Kingston, Ontario, and I specialize in providing retirement income and succession planning strategies to individuals and small businesses. I'm not here to sell anything today, just provide good information. Before we get into everything, let's just take a look at some of the challenges that are facing Kingston retirees in 2026. First of all, there's the threat of the higher inclusion rate on capital gains. Now, of course, as we know, that was threatened to come into place in the last federal budget. It wasn't picked up, thank goodness it wasn't. It could have been raised from the current 50% to 66.67%. It is off the table for now. It is something that could raise its head again in the future, as our government has only one source of income, and that's you and me and our tax dollars. That said, there's not much we can do about it, but it is something to be mindful of. It really makes it all the more important to look at saving wherever you can. The second issue that Kingston retirees are probably facing in 2026 is the threat of old age security clawback. The threshold as of July of 2026 is $93,454. And what that means is for a retiree, any amount of income that they're making over that, for every dollar of income over the threshold there, 15 cents of their old age security is clawed back. So by the time said retiree gets to an income rate of between 150 to 157,000, depending upon how old they are, effectively all of their old age security is clawed back, despite having paid into it all their lives. A third concern that retirees might have would be the retirement income fund minimum reduction. Again, a proposal in the last federal budget that was not picked up. What this would have done for retirees would be to reduce the amount that retirees must take out of their retirement income funds or RRIFs every year. That would have created less mandatory taxable income. That also potentially could have stretched out the life of their retirement income fund because less capital was being drawn or was required to be drawn every year. So that got tossed out, unfortunately, making it harder for individuals to save on taxes. The alternative minimum tax or AMT rules have been tightened as of the last budget to focus attention more diligently, I guess you could say, or more strictly on higher income earners, people who are earning over $170,000 after adjustments to their reported income tax. So CRA is again going after more aggressively, committing more resources to a smaller pool. So for high income earners who are retirees, this is something to be concerned about. And lastly, probate fees in Ontario are still 1.5% on estate values over $50,000. This is obviously a big thorn in the side of people who have maybe waited 12 months to 18 months. They've gone through all sorts of, they've jumped through all sorts of tax hurdles and reporting hurdles, being the executors, or even just waiting to be a beneficiary, and then at the end having the net estate reduced by 1.5% for the cost of probating the will. So those are some of the concerns. I think those are probably the big ones that Kingston retirees are concerned about today. And here's what I'd like to talk about today in terms of strategies to help you protect your wealth against some of the threats that I've just highlighted for you. The 5 strategies are the RRSP meltdown, prescribed rate loan, the cottage insurance swap, insured annuities or charitable remainder trusts, and lastly, alter ego or joint partner trusts. Let's get into the first one right now. And again, for today, the purposes of today's conversation, I'm just going to provide an introduction to these 5 strategies. If you want to know more, please feel free to be in touch with me. So that said, let's dive in. The RRSP meltdown before age 72. Most people's retirement savings plan strategy looks something like this. Quote, Just leave the RSP alone until you're age 71, and then start drawing money from the RRIF at your age 72. Again, you have to convert your RSP into a RRIF by the end of the calendar year in which you turn 71. You don't have to take any money out until the calendar year in which you turn 72. And again, that's a strategy that most people that I encounter have picked up early in life and just ran with. It's very easy to sell people on this strategy because of the adage, tax deferred is tax preferred. Nobody wants to pay taxes today. Most people are very comfortable putting it off until the last minute. It sounds like a great strategy because you're not paying taxes today, and your income is allowed to grow tax-free over time. There's a lot of advantages to that, but there is some problems. And the problems are this: potentially higher than necessary taxes paid during retirement, potentially lower or even eliminated old age security payments, and lastly, the residual value of the estate could be reduced or eliminated after years of overtaxation, old age security clawback, and finally, probate and taxes at death. So one solution to the problems that I just outlined is the RRSP meltdown. And essentially what this means, to sum it up in one sentence, it's deliberately and proactively taking money out of the RSP and paying taxes on it before you actually turn it into a retirement income fund and have to start taking it out. Well, why would anyone want to do that? They have to pay tax now versus later. Okay. Well, here's what I would propose to anyone who came to me with a certain series of problems that caught my attention. I would want to conduct a thorough analysis of what all of their future sources of retirement income were going to be providing them. And then, based on the analysis, I would ask, does actively drawing money from and paying taxes on RSPs before retirement make sense? And by make sense, I mean, does it mean lower lifetime taxes paid? Does it mean reduced or eliminated OAS clawback? And lastly, will there be a higher net estate value to pass on to heirs or charities? If the answer is yes to those three questions, then I will work with clients to figure out how best to implement that plan. Again, no two people are going to be the same, but we would figure out together what appropriate amounts would be to take out from the RSP annually. Obviously, know in advance what the tax amounts are going to be. Take the after tax amount of money that's been taken out of the RIF, or sorry, out of the RSP, and then invest that in a more appropriate vehicle. Third, third part of the strategy, client therefore arrives at age 72, now with a significantly smaller RIF than what it would have been had they just done nothing, sit back and wait until age 71, convert to a RRIF, and then start taking money out at age 72. This individual who's undertaken the RSP meltdown at 72 now has lower minimum annual withdrawals, which means less tax to pay each year and potentially more old age security to keep. And lastly, they have the potentially larger residual estate value to pass along again to their heirs or charities, whomever they want. So again, a RRIF meltdown strategy, it doesn't make sense for everybody, but in some cases, it really does make sense. The second strategy I'd like to look at briefly, just to introduce to you today, is the prescribed rate loan. Prescribed rate loan is an interesting strategy. There's many different ways of describing it, many different situations that would apply. I've chosen this one because I think it's a really easy example for people to get their heads around. And essentially, a prescribed rate loan is a strategy that works when you are basically lending money from someone who is in a high income tax bracket to somebody who is in a low to nil income tax bracket. In the sense of how to explain this to people very, very readily, this example, I wanted you to think about an elderly person, maybe not too elderly, but somebody who is already retired. She's got a fair bit of money sitting around, not really doing anything. She's got an adult child who's struggling. She wants to help the younger family member who's struggling to find work, going from part-time job to part-time job. She wants to help this adult child, but not with an outright gift of cash. What are some of her concerns? Well, why not just gift it? Well, before that, If she invests it for herself, if she doesn't think about her adult child and she invests it, she knows she's going to create income. She's going to create income that's going to increase her tax bill, and it may actually increase her taxable income such that she's now having old age security clawed back. There could be other problems, but let's just leave it at that. What's the problem with gifting? Well, what if she needs the money later for her own needs? She's very aware of the fact that, yes, her expenses are being met very well today, but if there was suddenly a health issue where she needed in-home medical care, which is very expensive, an outright gift today might mean no ability to access that money later on in life. The child might need it. There might be a family conflict, or in worst case scenario, the younger family member who's an adult child may end up wasting the money and it's just gone. So these are real concerns that a person in this situation would have. How does a prescribed rate loan work and how does it help people in this situation? Well, when you lend money at the prescribed rate is a rate that is set by Canada Revenue Agency to say that if you're going to loan money to people and you don't want interest income attribution rules to apply, then you've got to charge them at least 3%. And that's the rate as it is for the first quarter of 2026. The good thing there is that we're in a low interest rate environment right now. So that if you were to ever enter into a prescribed rate loan agreement with somebody now or in the near future, even if interest rates went up dramatically in the next few years, your prescribed rate loan rate would be locked in at 3%. So just something to note there. And again, by doing so, by using the prescribed rate loan strategy, it's a formal document that's crafted. There is a requirement that the recipient of the loan money has to pay the 3% to the lender by January 31st of the following year, every year, or the agreement could collapse and CRA won't recognize it anymore. So that said, it's very important. You want to set these things up properly. What happens here? The loan money is provided to the adult child again at 3%. Now, what has this actually resolved? Yes, the child has money to help with life. The adult child can invest the money. And because they are paying the prescribed loan rate back to the lender at least once a year, there's no income attribution. So nobody at CRA can say that the lender loaned the money to the adult child simply for the purpose of tax avoidance. So there's a loan agreement here. 3% interest is paid back every year, no income attribution back to the lender. Second advantage is that all the growth on that money is outside of the lender's estate. That money is outside. Let's say it's $500,000, right? Should the lender pass away suddenly, that money is no longer in her estate. Therefore, it's no longer subject to probate. Now, another important thing to note, it's a very good idea if you're going to embark on a strategy like this to speak with your lawyer and make sure that there is some sort of inclusion of the prescribed rate loan, some sort of mention in the will, either directly or by codicil, that forgives the loan. As long as the debt is forgiven, then there's no risk of the loan amount being attributed back, coming back into the estate, being charged probate and causing a lot of hassle. Third advantage here is that it's a demand loan. So again, this woman who is getting on in life worried that in the future, if she should suddenly become less healthy, she can always call that loan back at any time. That's what a demand loan is. So that satisfies her needs. It's not a permanent arrangement. And it's not money gone forever. Prescribed rate loan also remedies the otherwise lacking income splitting opportunities. Income splitting opportunities, like anyone who's a small business owner would know that in the budget of 2017, there were many income opportunities for business people to sprinkle income among individuals in the family, children, whether they were working or not. Those all got killed by that budget. Well, the prescribed rate loan strategy basically steps in and saves the day for anybody who's looking to do something like that. And of course, it works great with cottages or cottage corporations or trusts too. It's not just for individuals. So that's the prescribed rate loan strategy. The third strategy I'd like to introduce quickly is the cottage insurance swap. Again, let's say, for example, that you and your partner are small business owners and living the dream. You got a beautiful home and a beautiful cottage, and your kids have grown up at the cottage. Now, two of the kids really love the cottage. One of them is maybe not so inclined, doesn't really like it, doesn't really want to inherit that. Um, that could be a problem. That could create conflict later on when the business owner, the partnership, when they pass away. Conflict in the family could be a problem. Bigger problem that's really unavoidable. It's not a subject to negotiation or speculation. Is the capital gains tax that's going to be applicable on the deemed disposition of this cottage property? Because again, it's not a principal residence; it's a secondary property. Lots of people are familiar with, having bought a cottage for very, very little money many years ago, and now it's worth a lot, and so they face this problem quite readily. The cottage insurance swap is a strategy to essentially address the capital gains issue. Now, it can help to reduce family strife as well, but basically the strategy is to first of all, have the cottage be owned by the corporation, and there's simple ways to make that happen. The corporation then pays the premiums. They're not tax deductible, but the death benefit is tax free. Whatever that death benefit amount is, it could take into account what the projected capital gains is going to be on the cottage. It could also take into account the fact that maybe you need some extra money to buy out one child so that the other two can keep the cottage in their families, and the third child that doesn't really want that cottage anymore gets an equitable distribution of the property. So the insurance strategy basically resolves all of those problems with really zero cash outlay at the time the estate is being wrapped up. Just to summarize how it works in detail. Again, premiums are paid by the corporation through after-tax retained earnings. They're non-deductible, but the death benefit is tax-free to the corporation. Any excess, the death benefit amount in excess of the insurance policy's adjusted cost base is added to the corporation's capital dividend account, which then allows for a tax-free capital dividend to be distributed to the shareholders. In our example case, the shareholders would be the 3 adult children. And this strategy is ideal for anybody who's looking to cover future capital gains on corporately held assets like a cottage. It preserves more of the family assets after tax, and it can be customized to tailor unique situations. So saving on taxes and keeping family squabbles to a minimum, excellent way to achieve those through the cottage insurance swap strategy. The fourth strategy that I'd like to introduce to you is the insured annuity or charitable remainder trust. Again, imagine two different scenarios here. Regardless of the scenario, these are two powerful ways to get more guaranteed income and also to slash or eliminate old age security clawback. The charitable remainder trust or the insured annuity can achieve these goals quite powerfully. The charitable remainder trust. Imagine a couple, say, who don't have any children, but they have charitable intentions. They know one day they are going to want to pass on a tremendous amount of their accumulated wealth to the charities of their choice, rather than simply have it go into a big tax bill and have the Canadian government do what they will with that money. They have charitable intentions. So what they want to do by transferring some assets into a charitable remainder trust, maybe the assets that they had earmarked for gifting to charity at death anyway, moving those assets into the charitable remainder trust, divest the owner of the tax creating assets, so they're no longer creating taxable income in the hands of the individuals. It's now creating income in the hands of the trust. So it reduces income and potentially the OAS clawback burden for the donors. It reduces taxes because, again, their income is now reduced. It reduces probate because, again, that asset is no longer owned by the individuals. It's owned by the trust. So the third and final aspect of this strategy is the receipt of a charitable donation, which can be used for the couple to achieve a great tax benefit while they're living. You need to go to an actuary. They charge about $1,000 to assess what your charitable donation will be worth, and as its present value, you get a receipt, and then you can apply that accordingly. So you don't have to wait till you pass away. You can get the tax break today. So an excellent strategy for individuals without kids who want to apply a tax strategy to their favor. Imagine now a strategy for people who are very similar, but they do have kids. And what they want to do is they want to maximize the estate value for their children. And they also want to create more net income after taxes for themselves. What they can do is apply or follow the insured annuity strategy. The first thing that you would do in this particular case would be to apply for an insurance contract. Because again, insurance contracts are subject to underwriting. Got to make sure you're healthy, right? And you got to make sure there's no surprises. So you would apply for a whole life insurance policy, something that's good for life, right? It's not gonna, the premiums are never going to go up once it's underwritten. So assuming that it gets underwritten successfully and you're happy with the premiums, then you can take the sum of disposable cash that you have. This cash could have come from the sale of a business, for example. It could have been an inheritance. It could have been maybe you were proactively using an RRSP meltdown strategy with me. It doesn't really matter, but you've got this sum of money that, let's say, for example, if that sum of money had been in a RIF, it would be generating fully taxable income every single year. But instead, now you've got this money and you go and you buy an annuity with it. And instead of getting fully taxable RRIF income, now you're getting tax advantage cash flow from the annuity because, again, an annuity issues you partly a return of your own capital and partly the interest earned on it. So instead of being fully taxable income like a RRIF, the tax burden is much lower than that. You have this greater amount of money left over after taxes. Some of that money, of course, is going to go to pay the insurance premiums, but they're already known. And the annuity payments are already known. So you have great confidence in knowing, okay, here's the money that's coming in. Here's the money that's going out. I don't have to worry about this. And if it's structured properly, you're going to have leftover income to do whatever you want with and enjoy your lives. Finally, when you do pass away, the last person passes away, there is this tax-free payout from the insurance contract that increases the net estate value that may not be anywhere near that high if the money again was just sitting inside a retirement income fund, and then you pass away and all of a sudden half of it is basically going out to pay taxes. So those are the charitable remainder trust and insured annuity strategies. And the last one that I wanted to introduce to you today is the alter ego trust. This is a fantastic strategy for anyone who is over 65 years old, has over $750,000 outside of their RSP or RIF, and who wants total probate avoidance, wants privacy, and wants creditor protection. An alter ego trust, again, is a trust that you can set up once you're 65 years old. A joint partner trust would be, maybe you and your partner, you're both over 65 years old, and your spouse set up a joint partner trust. So you're both trustees to this, this trust. And it's set up to hold certain assets that you have outside of your own personally owned assets. And again, by moving assets away from personal ownership into a trust, again, you get the automatic reduction of your estate value, automatic savings in probate. It costs more to set up than a will. A will might run you anywhere between $300 to $3,000. An alter ego trust would probably run you here in Kingston about $7,500. It's definitely worth more to set up. You again are the trustee, or if it's a joint partner trust, you and your spouse are joint trustees. And the alter ego trust is not taxed any differently than your other assets. It's just not taxed to you directly. But the trust still has to pay taxes. So what are the advantages of doing that? Well, as I already alluded to, the assets now that are part of the trust are no longer subject to probate. So there's instant savings right there. Again, because these assets are now part of a trust and not held personally, there's strong creditor protection in that trust. Creditors can't touch them, whereas your will not protect you at all. from creditors. And also, unlike your will, you have tremendous privacy in the trust. When a will is probated, it becomes part of the public domain, and anybody can go and read it. This could be a former business partner. This could be a former business competitor. This could be persons from a previous marriage. Your will isn't going to provide you with any protection or privacy in those cases, and it does open the door potentially to challenges of your will, whereas holding money in the alter ego or joint partner trust ensures that only those who are party to the trust are going to know what's in it, who got what, and so on. So amazing privacy benefit there. And lastly, of course, the beneficiaries are going to get their money in weeks versus what is the average in Ontario for a will to be probated, and that's anywhere between 12 months to 18 months. So beneficiaries get their money very quickly. There's privacy, there's creditor protection. It's a fantastic solution for anybody who is a high income person, lots of assets, and are looking for the advantages that I've just outlined here on the screen. So that's it. Those are the 5 strategies. Thank you very much. I want to just do a quick comparison so that I can refresh you before you go. All of these strategies that I just introduced, all 5, if there are children or grandkids involved, if that's your intention, all 5 of these strategies can help them. Hands down, no problem. All 5 of the strategies will help you avoid probate. 2 of the 5 will reduce your old age security clawback, and those are the RRSP meltdown strategy and the charitable remainder trust and insured annuity strategies. 4 out of 5, with the exception of the alter ego trust, are going to reduce your income taxes. So depending upon your situation, there's most likely there is a solution somewhere in here that's going to help you keep more of your money, pass on more of what you want to your heirs or your charitable beneficiaries. Again, what happens if you do nothing? Well, for the average high net worth Kingston couple today, doing nothing means a lot of unnecessary taxes paid, family assets at risk due to limited creditor protection, old age security reduced or eliminated for one or both spouses. The family cottage may have to be sold to pay a tax bill or to resolve a family feud. And lastly, zero privacy when the couple passes away. I wish I could say I knew everything. I've been working here in Kingston for over 21 years now as a certified financial planner, and I have to say, probably just begun to scratch the surface of some of the issues that are out there. And that's why I'm really proud of the team members that I have behind me that I can call upon when it comes to crafting investment solutions. Phil Peterson, who heads up our investment strategy team. He's our chief investment strategist and lead portfolio manager on a series of our flagship product. Always is looking to create investment products that are tax efficient. Tax efficiency is a core concept, a principal value here at IG. So Phil's a great resource. Probably more pertinent to what we've been talking about today, however, is that when there's a question that gets brought up that I honestly don't know how to answer, I can always call upon Christine Van Cowenberg. She is a lawyer, a certified financial planner with over 29 years of experience here. She's supported by a team that is comprised of lawyers, certified financial planners, accountants. They are housed in Toronto and Winnipeg, and basically every day they are spending their time looking at tax law, looking at things that are the cases, issues that are before the courts. Again, I don't think there is really any question that I could put to Christine, any unique situation that I could put to this team, and they wouldn't be able to come back with a clear and reliable answer for. So again, very proud of the team that I have behind me. Very confident that we together can resolve most any issue that a client might have. I want to thank you all very much for spending the time with me today to let me introduce these concepts to you. If you have any questions at all, please feel free to email me. My email is on the screen, or my cell number is there as well if you prefer to give me a call. Be very happy to take your questions and help in any way that I can. Thank you very much, and have a wonderful day.